So there's always an increase in concern of what's happening with the markets, of course, when it comes to the dollar. It being the reserve currency and the fact that everybody keeps talking about it's just all made up numbers anyway. And then you have all this stuff that's going on when you see hedge funds buying up parts of the market. The housing is still getting really, really sucked up by them. And then the person in charge of the biggest hedge fund is a chairman, or at least an interim chairman of the WEF, the World Economic Forum. That's always a concerning group of people because it seems just basically a big group of rich guys sitting around tasting wine together like a big ass wine club talking about the global markets and what they're going to do to influence it. So governments, markets, industry, all influenced by people sitting around jerking off, talking about what they think should happen. And then it starts to affect us. What they want to do is start pushing things when it comes to, you own nothing and be happy. What's going to happen with our currency, with the value of our assets. Well, it being September 2nd, we're going into that fall trading. That always has some sort of influence. For some reason, that's just something that goes on in a seasonal deal. I don't understand how that always works, but it seems like this is just my opinion, especially things that I start looking at and I'm reading in the markets. A lot of your senior traders, they disappear. Kids are getting ready to go off to school. They're sending people to their older kids to college. They're taking time away. They go sit in the Hamptons for a few days. You got that long 3-day weekend. They come back. We'll show in the charts. They're going to remedy some of the decisions that were made by the younger traders that stayed during that whole holiday time, and now they're trying to remedy what's in their portfolios. We also have a broader bond market sell-off that's driven by some concerns of fiscal instability in the U.S., in France, UK. We have the U.S. Treasuries approaching 5%. There's also uncertainty over the Fed's independence and the policies. You've got the Trump administration trying to remove Governor Lisa Cook, who's pushing back and contesting that. That has some sort of influence on things. There is continued back and forth between the administration and Jerome Powell on what's going to happen with short-term rates, which also affects long-term rates. We're starting to see a jump in gold, jump in silver. That's pretty significant, really significant movement there. And now we're starting to see the UMBS making moves kind of negative to the direction where it went this last week. So all of these things are playing a part. I don't have all the data that's come out yet. It's pretty early right now. It's 9 o'clock Central. I'm just looking at all the stuff that's happening. And we did see this big move with MBS's last week, but then there's a bit of a reversal. So we'll take a look at this real quick and show you the charts as always. And here, so we see the bonds again, I'm always wanting to look at the price action. We'll look at this big gap. I'm gonna open this up a little more so you can see it. Big gap up open. Down here, open here at 100.33. It pushed, tried to get above this resistance, this ceiling that was placed at 104.1, but then it's retracted back to about 103.8. So that's where we're sitting, 103.7 actually. So 103.8 is our resistance. So we're pushing on that. We went up into that QE block and it got just completely slapped down. So that's how big of a drop that was. From where it just went, it was stasis yesterday because of the holiday, and then it got slapped down to an open of 25 basis points, full drop down into one of our moving averages for 30 basis points. It's now about 21 off of where it was on Friday, which would be, and then also yesterday when it was just closed trading. This is something I thought was going to be in a situation anyway. Us being pushed out of that because it has done that over and over and over and over again. I'm showing you guys this long term, what we can expect for these bonds. Now, doesn't mean there's not going to be some quantitative easing coming. There is some consideration that I'm hearing when they're talking about the Fed, the current administration. Trump keeps talking about wanting to get those lower rates to help the people out. He's trying to be that president. Then you also have Larry Fink, who is trying to make sure that our housing goes through the roof, and affordability is impossible for the next generation. That's why I'm doing what I'm doing when it comes to the family trust for the holding companies, the other LLCs acquiring houses for every member of my family to be able to occupy and lease from the trust, which is ultimately from themselves because they're the beneficiaries. But look at this. This QE block has rejected it over and over and over and over again. Everybody keeps talking about these when you start listening to other loan originators, other people that are talking about the markets, what's going to influence the markets, what they believe is going to happen with interest rates, how they're going to end up going back down. I still firmly stand right there with the evidence in front of us. Now, could I be wrong? If they start quantitative easing again, they start deciding to bring interest rates down. One, so because it makes them look good. That's a good political thing. It's something that the Fed would like to be able to say, "Hey, we did this for you." But in reality, it's a negative for us. We drive those interest rates down. It's going to drive the price of housing through the roof, and it's going to make the affordability index damn near impossible. It's going to look good because of the low interest rates, but it's going to really, really suck for the value of the home or the price of these homes. Then when rates have to move back, what's that going to do to the next couple of generations? But what's it going to do for the people that are holding the real estate? If you don't have it, you won't be able to get it. There's going to be massive competition. So you should be getting into this now. And if you also have people like Larry Fink and those who run these monster hedge funds that are trying to influence that QE and trying to influence these things, at least it sounds like. I'm not sitting in these rooms. I don't know, but it's a good solid possibility that what we're hearing has some accuracy to it, that they're trying to push home ownership as an impossibility. How do you do that? To drive the prices to the point that people can't afford it because they will own it. It's anticipated they'll own 60+% of the housing by 2030. They'll rent it to you. We are becoming a subscription-based economy. It's happening all over the place. Get in the game. If you're wondering if now's the right time, it's been the right time. It'll continue to be the right time. If you're on the field, you'll be in the highlight play. That highlight play will be available to you at some point. Got great deals coming all the time. He's pushing out more data. But if you're not qualified right now, if you haven't contacted my team, you haven't gone to aaronchapman.com, let's just go there real quick so I can show it. If you have not gone here and scroll down here to get your loan application, you're putting yourself in a bad spot. Also, your LLCs, setting those up, you need to go here, schedule that conversation. Infinite banking, schedule that conversation. Then get with me when you schedule those conversations. Start the loan application, know what you're qualified for or what you need to do to qualify for more. When you take the assets you have, look at the infinite banking, start getting your LLCs, get your holding companies, getting all those things in place. If you're not doing that, you're setting yourself up for potential risk of loss for any access in the future. So reach out to me, aaronchapman.com, and we'll catch up with you real soon. We'll talk to you on Friday.